Guidance for Standard 4 examines the CFA Institute standards related to duties to employers within the program. Standard 4 establishes the professional responsibilities investment professionals owe to their employers while balancing broader ethical obligations to clients and market integrity. The standard is divided into three components: Standard 4A loyalty, Standard 4B additional compensation arrangements, and Standard 4C responsibilities of supervisors. These standards promote professionalism, transparency, accountability, and ethical conduct within financial organizations. Investment professionals must act honestly and responsibly toward employers while ensuring that personal interests, external incentives, or supervisory failures do not compromise professional integrity or fiduciary obligations to clients and markets. Standard 4A loyalty requires CFA Institute members and candidates to act for the benefit of their employers and avoid conduct that harms the employer's interests. Employees must perform their professional duties with diligence, competence, and good faith while protecting confidential employer information and resources. Professionals may not engage in activities that compete unfairly with their employer or misuse company assets for personal gain. However, the duty of loyalty does not require blind obedience if employer instructions conflict with laws, regulations, or ethical standards. In such situations, ethical and legal obligations take precedence. This standard reinforces the importance of balancing loyalty to employers with broader professional responsibilities and fiduciary duties. The guidance for Standard 4A also addresses issues related to independent practice and employee transitions. Members and candidates may prepare to start independent businesses or seek new employment opportunities while still employed, provided these preparations do not interfere with current responsibilities or misuse employer resources. Client lists, proprietary research, and confidential business information remain the property of the employer and may not be taken without permission. Professionals should avoid soliciting clients or employees before officially departing from the firm unless permitted contractually. Ethical transitions require transparency, professionalism, and respect for contractual obligations to minimize conflicts and preserve trust between employers, employees, and clients. Standard 4B additional compensation arrangements prohibits members and candidates from accepting gifts, compensation, or benefits that could create conflicts of interest with employer responsibilities unless written consent is obtained from all involved parties. External compensation arrangements may compromise objectivity or influence professional judgment if not properly disclosed. Examples include bonuses from clients, referral fees, consulting payments, or incentives from outside organizations. Professionals must disclose such arrangements fully to employers before accepting them. Written consent allows employers to evaluate potential conflicts and determine whether the arrangement could interfere with professional duties, independence, or obligations owed to clients and the organization. Standard 4C responsibilities of supervisors requires individuals with supervisory authority to make reasonable efforts to prevent employees or subordinates from violating applicable laws, regulations, or CFA Institute standards. Supervisors must establish effective compliance systems, training programs, reporting structures, and monitoring procedures to promote ethical conduct within organizations. If supervisors become aware of potential misconduct, they are expected to investigate appropriately and take corrective action when necessary. Failure to supervise adequately may itself constitute a violation even if the supervisor did not participate directly in the misconduct. Strong supervisory systems are therefore essential for maintaining compliance, reducing legal risk, and promoting ethical organizational culture within investment firms and financial institutions. Overall, topic demonstrates that Standard 4 establishes important ethical responsibilities governing employer relationships and organizational conduct within the investment profession. Loyalty standards require professionals to act honestly and responsibly toward employers while balancing broader legal and ethical obligations. Additional compensation rules help prevent conflicts of interest that may compromise professional objectivity. Supervisory responsibilities reinforce the importance of effective compliance systems, oversight, and ethical leadership within financial organizations. Together, these standards promote accountability, transparency, and professionalism throughout investment management and financial services industries. For CFA candidates, understanding Standard 4 guidance is essential because ethical employer relationships and effective supervision are fundamental to maintaining trust and integrity in professional practice.